Welcome to LaTour Retirement Talk. I'm your co-host, Tony Shore, and I'm here with our hosts, Josh LaTour and Jim Margraf. Josh and Jim, looking great today, guys. I know that there's a lot going on out there that I want to ask you guys about as financial advisors and financial specialists in your field. Do you guys, before we get into it, do you guys have a lot of federal employees in your area?
Honestly, no, we don't have a whole lot of federal employees, which is probably a good thing right now. I mean, as you know, we've got the government shutdown going on, and so that's definitely having an effect on a lot of those employees. But yeah, this isn't a large area for federal employees.
Yeah. I was talking to an advisor who's in the DC area.
Oh, wow.
Near Reston, Virginia. So, you know, they've got Langley out there, they've got DC, and it's it's a real mess. They mainly focus on federal workers. Right. So
probably the majority of his clients are having some impact here.
Well, September 30th was the day that when they offered a lot of federal employees buyouts, you know, there's like 150, 200,000 federal employees that they said, hey, we're cutting the workforce down. We're trying to trim some things. But that's a lot of people, and a lot of them took the buyouts, and a lot of them decided to retire. Some were going to retire anyway. It's not like they were all let go. Most of them, it took the buyout or retirement option or were going to. But a lot of that just happened, and then the government shut down at the same time. So it is a problem.
Yes.
Yeah, absolutely.
So I just thought I'd mention that. And by the time this airs, maybe the government shutdown will be over. Let's hope it is. But today we're talking about the other big news, right? The Fed rate cuts. But before we get into that, I know Jim is itching to tell us about his life lately and what he's been doing. I can see it. What's going on over there?
Honestly, Tony, not a ton of stuff is happening on my life, except for, you know, things like in the family with like my father-in-law. He's been, you know, my wife has been taking care of him. He moved in with us a few years ago. But you know, my wife had an injury and she wasn't able to care for him. So we had to seek some other options. And finally he ended up in a nursing home here for a little bit.
Oh.
And when my wife went back in there, she's like, no, this isn't going to work. So he just came back home with us again. So it's she's going to take care of him until he gets to a place where we just can't, from a medical perspective, take care of him.
Yeah, that's hard, though. It's stressful. I know I went through it with my mom and dad, too, trying to figure out, we wanted to be able to take care of them. Some of those facilities are not great.
No.
You want to make sure you find a good one. That's tough.
And, you know, the thing is, no one is going to, for a paycheck, take care of your aging parent the way you would or would want to see them taken care of. Not even close.
Exactly. No.
And so, you know, he's back in the house with us, and, you know, you got my kids there, got dogs there. And of course that keeps him entertained as well. So, you know,
that's good.
It is going to be better, a little more work for us, but, you know, my wife took the perspective. She said, well, he took care of me for how many years? So I can take care of him for a few years.
That's my perspective. As soon as we're done here today, I'm driving down. I got to help my dad and mom with some things and Medicare paperwork and long-term. We've just moved my dad from long-term or from assisted living to long-term. Hasn't gone well. He doesn't like it. So we're got to figure that out. But it is, I'm an only child, so it's kind of tough. So it's just me. Right. But I don't feel sorry for myself. They took care of me and had to put, you know, me, they had to, they put up with
you.
Yeah. That's a lot. I put those two through heck. Right. But no, seriously, they did take care of me. And so I'm more than happy to, and I feel not the obligated is the wrong word. I want to, you know, I want to do it. Doesn't mean that it's not stressful and hard and for them and for me, but it is. I want to do what I can for them because boy, they did a lot for me to help me get to where I'm at. So you know, you got to appreciate that. It's turnabout is fair play, right?
It is.
Yeah, they took care of me for so many years, and now it's my turn. So there you go. Well, hey, the Fed rate cut, interest rates when they drop, and I personally feel like they're going to drop again, because once Powell gets out, I think then there's going to be more rate cuts. I think I don't know. That's my take, but they say they might lower them a couple more times even yet this year. So they've lowered them once though, right?
That's right, Tony. Yeah, just recently here in this last September, we had a 0.25% cut. So now we're down to the point of 4 to 4.25 range on the federal funds rate. So that that does have some impacts. I mean, the stock market, it's impacted it. The market has liked that. It's been anticipating rate cuts throughout the year, and basically, I've found anytime Jerome Powell, the Fed chair, opens up his mouth, the market is going to swing one way or the other. And so anytime he has delayed the rate cuts that the market was expecting, it seemed to have a negative impact, at least for a short term. Yep. And when he talked about doing the rate cut, then it seemed to have a positive impact again in a short term scenario there. And so now that we finally had that cut, the market is liking that. So we'll see how it continues going. But even as of today, we're at record highs.
Yeah, so, isn't it crazy? I mean, even with the government shutdown, the market's at record highs. That's
right.
Pretty impressive.
Well, the thing with the government shutdown is there's nobody there to do anything. So companies say, "Hey, well, let's go make some money."
It's true. It's true. So that is true. Yeah, no, I think that's good. So they cut the rates. They cut them only by 0.25%, and they might be adding to that. But I think they said maybe it was the labor market that had something to do with their reasoning for cutting rates.
Exactly. Powell kind of named this a risk management cut, looking at some of the unemployment numbers, the labor market. Now, let's take into consideration right now the labor market. The numbers are kind of skewed. We have some immigration policies that are going on right now that are changing things in the labor market. I mean, when you have 1 million people leave the country either through deportation or self-deportation, there's a lot of those who have decided to leave.
Yeah.
That's going to change things in the labor market when you don't have those people working anymore. But that same 1 million people is not considered an unemployed American at this point. So it's difficult to get the numbers correct. And I think that's where a lot of those who track these numbers, they're struggling to get things into check, because this is something that we haven't really experienced, at least in the recent history.
Yeah. Yeah. So the Fed rate cut, it's interesting. I'm surprised a lot of people are surprised they didn't cut them before. I know there was a lot of pressure from the administration on the Fed to, hey, you need to be cutting rates. A lot of people felt that way. A lot of the talking heads too felt that way, and people were surprised that they didn't do this sooner. What's your take on that? I mean,
well, I would say the Fed likes to try to respond to situations as though there's no real outside pressure. So they like to try to respond as though Trump is not pressuring them to lower the rates. But there's so many factors that they're looking at. But when they're making these changes, it's I have to say, when they look at all, it's a best guess, because sometimes they move too far or not far enough. And, I kind of like the way Powell put it as a risk management cut, and the fact that he was saying, hey, we see some things going on. It's not really, from their perspective, enough to justify a larger rate cut, but we're going to start to move things in a direction in case of. Because the market was kind of wanting the rate cuts earlier, and they didn't see enough justification to do so. But they're seeing some things moving, and you got the jobs report, which is Josh just very well described, is not an easy thing to figure out right now. So it's a a little bit of a CYA, I think, move on the Fed to cut it a quarter percent. And we can, at the next meeting, hey, we can go another 0.25% if we need to. It was interesting. The newest Fed member was actually dissented and said, hey, no, this should have been, and he came out and said this should have been a 0.5% rate cut. So it's not unheard of to have someone disagree like that, but it's definitely not common, especially for one of the newest members to do that. Usually they kind of go along with the rest of them, but there's still a lot of things. We're kind of in an environment where so many things are shifting, so many things are moving. We're still kind of in a wait and see. Where are they going to go? Are things going to keep going in a general direction where we need to cut rates further, or do we need to pause? Mm-hmm. There's so much going on and so many moving parts. We do need a little bit more time before he cuts them again. That's the way it sounds like he sees it, and I can't say there's enough evidence out there where I would say I completely disagree with him, but he definitely makes a rational argument.
Yeah, and I think to the point of you mentioned how the Fed doesn't like to make changes based on pressure that they're receiving.
Right.
Honestly, I don't feel like there's a whole lot of ammunition in that pressure because Jerome Powell has an exit. I believe it's May of next year anyway.
Right.
Yeah,
so he's
leaving.
Not that far out. I mean, the threat of replacing him really isn't. It's kind of an idle threat, in my opinion.
Yeah.
So,
right.
So
but he will be replaced at that time, and that may be a person who's more apt to go along with that feeling of, hey, we need to be lowering rates to help the overall economy. I don't know. We'll see. That is interesting. And well, I know that the Fed didn't all agree. There's the Fed. It's more than just Jerome Powell. There's a group of people that make up the Fed. I forget what they call it, like the council or whatever it is. But the newest Fed member didn't agree with the rate cut, did they?
No, Stephen Moran, he did not. So he thought that they should have gone with a full 0.5%. So it's not. Like I said, it's not normal for someone to disagree like that. It's not unheard of, but it's not exactly common either.
Yeah. So how does this affect everyday people out there?
Well, I think it's going to have more of a gradual effect. I mean, like we said, it's not a giant decrease at this point, but we are going to see some effects kind of going forward. Borrowing is going to get a little bit cheaper. So if you're getting a mortgage, I got a mortgage back in May of 2024, the pinnacle of interest rates. Lucky me.
That was
way to go, John.
Congratulations, buddy.
All of my
as a financial advisor, do you recommend that? Or?
I don't, Tony. all of my older clients, including my builder, my home builder, like to let me know that when they got their first homes, it was in the 70s and 80s, and their interest rates were like 13%.
So I remember my parents, I think, had a 14% at one point. Yeah. And my wife and our current is 2.9. So you chew on that one for a while.
Tony.
Keep rubbing it in on him, Tony. Keep getting him.
I'm just twisting the knife. Yeah.
I started at 7.9. And I got lowered to 6.9 this year. When
our first mortgage, we got a deal when we refied for 9% or 8.9, and when we lived in Nashville, we got a house there, and we were all excited because it had been like 10, 11, and we got it at 8.9. So it's all perspective on where you're at.
Really,
but for so many years, we had interest rates were like at nothing. Almost zero. So you had 2, 3, 4% interest rates on home. But what realtors would tell you, Josh, you're not buying an interest rate, you're buying a house, and you can change the interest rate, right? It's like it's like not buying a house. Their argument would be, it's like not buying a house because you don't like the color. You can repaint it. You're buying the house, not the color of the paint. You're buying a house, not the interest rate. You can always refinance when it goes down, right?
That is correct. Yeah, absolutely. And that's my plan. And now, so like I said, mortgages are going to get cheaper. Yep. I think for what I did, it was probably the best way we could have done it. We had a variable rate that could change annually. And because we knew that rates were supposed to be coming down, they were slated to come down. I was okay with having a variable rate in that scenario. But one of the things that I think even the Fed has cautioned people, we're probably not going to get back to the point where we were back in 2020 through 2022, where rates were just bottomed out. You're not going to see those 2.9s again, at least for the foreseeable future. I mean, it could happen again, but that's not what the plan is currently. Inflation numbers just don't support that. So don't expect to get those crazy low rates, but you may get down into the fives, maybe over time here. So as rates continue getting cut over the next year or so, we could start seeing some mortgages at a better, definitely a better rate. Now, that also does have an impact. You asked, how does this affect people on the everyday? Well, it's going to have an impact on your CD rates.
What's the negative here for people?
Well, Tony, I mean, for those who have CDs, fixed annuities, things like that, who are relying on some of those safe money options, even savings accounts. We've mentioned on the show before about the high yield savings accounts you can get. We're going to see some effects on those. And I think it's going to be an ongoing effect as rates continue coming down. Those are going to suffer. So while we have, there's always positive and negative. There's some give and take. Like I said before, Fed decisions seem to be a catch-22. There's going to be some good and some bad.
Right.
Refinancing is going to get a little bit cheaper for people, but some of the rates you can make on your money are going to go down, particularly in those safe products.
Josh, as you're saying that, I'm thinking about the fact that on some of the high yield savings accounts that I have, before the one company, they anticipated the drop, and they let me know my interest rate was going down before they announced it, and the other one waited until after. But so I'm making, actually on the one, they dropped it 0.25%, just enough to match what the Fed did. The other one dropped it a lot more. I think they dropped it a half, the ones that did it in anticipation. And so
they were following Stephen Mirren.
Yes. Right. Yeah. So, it is going to affect the rates that we earn. So, but the rates that we pay is going to affect them, if all the rates come down, the ones we pay are going to get better, and the ones we earn are going to get a little less.
Yep.
Exactly. So, and the thing is, for people with houses, you say, well, if the rates come down, then that makes the mortgage more affordable. But how fast do they come down? How fast do the rates keep coming down, and how much does it affect the mortgages? We still don't know. It's going to take some time to tell, and we'll see.
And I think too, because this was so anticipated,
right?
I don't think it's going to have as drastic of an effect on mortgage rates as it would have. Because the market anticipated this, and so it already kind of built it in.
Yep.
It was already expected, and so it was built into the prices already.
So normally, when interest rates drop, that tends to spur demand for the housing. But we're not down. Like we were talking before, some people have those really good rates still, and they don't want to sell.
Right.
They don't want to go from that 2.8 or whatever it is, or 3% mortgage, and end up at 6 or 6.5.
Right.
So that kind of also has an issue with the housing market as far as supply.
It does,
because people are going to put off selling their house or moving unless they have to for some reason.
Yep. No, exactly. And there are things that, there are other outside forces that cause people to still go ahead and sell. I mean, there's life changes, job changes, divorce, things like that kind of dictate that somebody's going to still have to sell their house and just kind of bite the bullet and still take on that higher mortgage rate than what they already have. But if all other things are equal and you're just thinking about changing homes, it's going to be hard to give up a low rate that you locked in back in 2020 and take on that higher rate. Tony, I can't imagine that you and your wife would choose to just go ahead and move neighborhoods, get rid of that 2.9%, and all of a sudden you've got a 6.5. That's
Right.
probably not going to happen,
Nope,
unless
it's
something
not.
had to.
No, in
So-
fact, we've been wanting to downsize because all our
Right.
kids are now out of the house, and we'd like to get a one level, like a Rancher Rambler style,
Right.
where we can age in place and just downsize a bit. We've even looked a little bit, but we're not doing anything because we have a 2.9% mortgage,
Right.
and we're not going to jump to a 6.9. I mean, that doesn't make any sense.
Yeah, so that's the same effect we're seeing across the industry. Even though rates are coming down, and
Yeah.
so in theory, there's going to be a lot more homes bought and sold. People are going to be slower to sell because they've already locked in a previously lower rate.
Yeah, exactly. So, I mean, mortgages, that's the first thing a lot of people think of. But what else does it mean? What else happens when the Fed lowers interest rates? You already mentioned markets. They usually respond in mixed ways, but boy, they do
Right.
like it right now, huh?
They do. So one of the things you may want to consider, you say, well, I'm looking at the balance of things in my portfolio, right? So I have a fair amount set aside in things like CDs or the MIGA annuities, and they're at that fixed interest rate. But when I go to renew the CD now, or I go to get a new MIGA, the rates are going to be a little bit lower. So what I might want to consider doing is looking at some different types of investments for myself. Maybe I don't want to leave as much cash, maybe even in the high yield savings, because I'm not going to be getting the kind of rates that I got before.
Right.
So now it's a time to say, well, maybe I need to look at my risk profile. Maybe it's time to sit down again with my financial advisor, come in, sit down, let's go through the risk profile again and take a look. How am I balanced? How am I allocated? How much cash do I have sitting on the sidelines? Because if the rates are coming down, presumably that helps some things in the market, helps boost some things. Maybe that helps provide a little bit of a tailwind for the market. And I can have those funds invested in growing there. Maybe we can find that portfolio that is still conservative enough that justifies moving some of those funds out of those fixed interest accounts that are coming down as the Fed drops its rates.
Yeah, that makes perfect sense. You want to have strategies in place. Obviously, there are things you can do if interest rates are coming down. I can see why it does. It helps businesses because they can borrow, they can expand, hire more people at lower rates. So that hopefully will fuel the economy. What else is there that we should know about the Fed rate cut or how it might affect us?
Well, I want to go just a little bit more into, I know we've talked a lot about mortgages, but I feel like this is a very big topic when it comes to rate cuts. So just wanted to talk about one of the other things that is impacting that market as well. Not only do we have higher rates than we had 4 or 5 years ago, but the cost of the homes has just gone up drastically. I mean, Tony, the median price across the U.S. right now for a home, for a single family home, $416,000.
Wow.
Yeah.
Utterly ridiculous.
That's crazy.
And so it makes it a lot more difficult, especially for younger people, for the millennial generation, into the Gen
You're just
Z
out of college.
generation.
You're starting your career. How do you buy your first home?
You're forced to rent.
Yeah.
Yep.
Yeah. My son is 26. He's married. He's out of school. He's had, post-grad work, school. And now he's got full-time career, but he's not making enough. He's like, I don't know if we'll ever be able to afford a home. That's a lot of people his age are saying. That's tough.
I hear that a lot. Yeah, absolutely. And so the thing that's going to help a little bit is these lowering interest rates. Because if you look at 7% on the median house price, the monthly payment for your principal and interest is going to be around $2,500. So for a $416,000 house at 7%, $2,500 a month. You drop that down by 1%, we're down to $2,300 a month. That's a pretty significant savings. That's almost not quite, but almost a 10% savings per month on your payment. So as rates come down, that's going to help that generation out a lot.
It will.
But it's still difficult. We're in the inflation that we had that was largely caused by COVID and by pumping too much money into our economy has really had an impact. And I think it's going to be a lasting impact.
Yeah. Yeah. I mean, I guess you shouldn't necessarily wait for the perfect rate, but it does make a huge difference, especially for younger home buyers. And, it depends on your situation again, but that's where taking a look at your financial picture and your financial future is a good idea to do that with a financial professional like yourselves, like your team there at LaTour. I think that's so important. Because again, a lot of people are sitting on the sidelines. The perfect rate might never come. I heard a quote recently that if you're hoping for the days of 2% and 3% rates, it's not going to happen again. And I hope that's not true, but
most likely though. And so I'll finish with this because I know we're just about out of time, Tony.
Yeah.
I think timing really any market is in order to do it, you have to be lucky, in my opinion.
Yes.
Yeah.
My wife and I, we decided to wait a little while before we started building our house because lumber prices were crazy high.
Right.
Well, lumber prices came down. Guess what happened? Interest rates went up. And so it's a balancing act, and it ended up being a wash.
Man plans, God laughs.
Exactly.
Right? I mean, you have no idea. I mean, nobody can predict the future.
Yes. And so in some ways you do just have to live your life. I mean, if you need a home, you may just have to buy the home. Of course, do what you can to be proactive and time it as best as you can. End of the day, whatever is going to happen is going to happen. And so you may just have to continue living your life despite all of these outside impacts.
Yeah. All the outside influences, and you never know when the next black swan event is going to happen. These things happen, 2022 or the tariff surprise, which caused some market volatility, or COVID. These things happen, but the markets continue, life continues, and it can work out. But you do need to stay on top of it or work with a financial professional so you don't have to worry about it or make emotional decisions. That's what you don't want to do, or don't do something just because your coworker did it. Right. So, or a buddy, you've got to make sure that you have a strategy that's designed for you. So how can our listeners out there set up that consultation to get a plan in place?
Well, Tony, they just need to give us a call. Phone number is 417-641-3497. And also check out our website, latourasset.com.
All right. Well, guys, Josh, Jim, great show today. A lot of great information about what the Fed's rate cut means for us and for our listeners out there. Listeners and viewers, thanks for tuning in. That does it for today's episode of LaTour Retirement Talk with our hosts, Jim Margraf and Josh LaTour.